Well, obviously, I think, the Federal Reserve, other central banks, they're going to keep doing what they do until there's some sort of a forcing function that comes upon them. I'm not clear if I'm seeing a forcing function out of the bond markets right now because there's some very interesting popping and creaking sounds coming out of a variety of government markets, but also at the edges. There was a lot of yield chasing and we had junk bonds with a four handle, crazy stuff. But the one thing that I think is out of their hands is the price of oil. And I see over your shoulder there, one of your books, the energy world is flat. And I want to talk now about the possibility that oil's my candidate for the thing that is you have to have it and you can't really control it. Now they tried with dishoarding the SPR, the Strategic Petroleum Reserve. That was the first time in my life that a president or a presidential team was day trading the price of oil, driving it down. Remember, they're going to buy it back at $70 to $72 a barrel. Oops. They haven't refilled a single drop of it overall after they dishoarded a little more last week. And so oil's now at 90. We've got all kinds of things going on in this story, but let's talk now about oil supply demand. Where do you see the story of oil right now?
Well, developed economies have been extremely imprudent in their policy relative to oil, as you have just mentioned with the U.S. government and the SPR. No, for a very for a monetary reason, oil prices in May 22 reached a peak of around $120 a barrel. Then, when the Fed started to hike rates, the monetary phenomenon kicked in, and with rate hikes and monetary contraction, all commodities collapsed to prices below the levels at which they were trading prior to the Ukraine invasion. So between May 22 and May 23, you had a move in commodity prices, including wheat, copper, you name it. All of the commodity complex collapsed because of a monetary phenomenon. Rate hikes means less money in the system. It's more expensive to buy long positions in commodities, more expensive to buy freight, to purchase freights, to store, etc., etc. So oil prices collapsed to May 23, but the underlying supply and demand scenario was getting tighter. And governments did not pay attention to that. Governments paid attention to the price, to the spot price. The underlying environment of supply and demand was getting tighter because on the one hand, you had supply cuts from OPEC plus, Saudi Arabia and Russia. You had challenges in non-OPEC supply because of the underinvestment that had been going on for years in the non-OPEC countries, the United States and North Sea, etc. This completely lunatic decision to stop investing in oil before there is a real alternative. No, so
Thank you.
supply challenge, and demand had been contained by China slowing down, but China starts to build up and starts to recover. So demand starts to go up while supply is more challenged, and the monetary phenomenon stops working in favor of spot prices. And in May 23, all those effects come to play, as you've just mentioned. And the oil prices start to go up, supply tightness is more evident, demand improvement is more evident, and central banks are not hiking rates and not reducing money supply. So suddenly there is flow into commodities and an underlying supply demand trend that justifies the move. So oil prices can overshoot in that environment, unless, and I don't think it's going to happen for what we have discussed just a few minutes ago, unless suddenly the Fed starts to hike rates massively and cut its balance sheet, which I don't think is going to happen. So oil prices can overshoot, and they would only come back with a massive destruction of demand, which tends to kick in at around the 120, 125 level. That is very evident where you start to see that level of destruction of demand.
Well, so let's talk about this from a fundamental standpoint, because we know the United States, however it did it, managed to lose Saudi Arabia as a core geopolitical asset. They seem to be
Yeah,
have turned a little bit to the east, we'll say. But meanwhile, the environment. So we're talking to you. You're in London. So in the UK, you've got people like spray painting, storefronts and gluing their hands to roadways, all of which sort of has to weigh in on corporate board decisions somewhere. So it's we're seeing this. We need a lot of investment in oil and gas to make up for these shortfalls, which come from a whole thing. We had the collapse of oil prices through 2015. No offshore is really being prosecuted right now. Very, very little relative to what we need. And as well, we're even seeing, the U.S. shale play. They've got, let's say, financial uh, diligence is returned to their operations, so they're no longer chasing the production stuff. On and on and on. I can make a case that we're going to be facing a very supply constrained environment, and I've been pounding on that for a while. And finally, Goldman Sachs came out, or J.P. Morgan came out and said, "Oh, looks like we're going to have a 7 million barrel per day shortfall by 2030." Like, this should have sent up alarm bells everywhere, because there's no such thing as a 7 million barrel a day shortfall. There's only a price that destroys enough demand to make that happen, right? This
yeah,
looks alarming
exactly.
to me from a price standpoint, and the Fed can't control that. There's no combination of money printing and interest rates that are going to prevent that shortfall, I don't think.
Only 7.5% interest rates and the Federal Reserve's balance sheet at 15% of GDP. But that's not good news for the market or for the economy, if you know. So yeah, you're absolutely right. In 2022, developed economies took for granted the artificial tailwind of very low commodity prices in the middle of a huge geopolitical change and
Mm-hmm.
massive supply demand shortages. And to be fairly honest, everybody that had a little bit of understanding of the supply demand scenario, from food to oil, was telling these governments, you are counting with a disinflationary process that is only going to last while central banks reduce money supply and cut rates. But the moment that they stop, it's going to come back viciously, and it did. Hmm? So so the Fed cannot control this. Furthermore, it cannot. The May 22 abrupt change in interest rates was not just the Fed. It was 180 central banks at the same time, raising rates. Think
Mm-hmm.
about this. 180 central banks raising rates means that there's an immediate shock in financial demand for commodities, in long positions, in hedges, in margin calls. So all of that is not going to happen. That is not going to come back. So I think that the problem right now is that you may find an environment in which inflation is persistent in core inflation, while energy inflation remains elevated because of what we're discussing, and um, and the tools that central banks had announced for a so-called soft landing don't work. Because I tell you, if it by right now, even if the Fed decides to hike rates by 25 basis points, that's not enough. Mm? Obviously, oil prices are traded in dollars, and that's an important factor. But that is not enough. What we need is a shock like the one that we had in May 22, in which you have suddenly, abruptly, and in unison, the European Central Bank, not the Bank of Japan goes on its own. The European Central Bank, the Bank of England, the Fed, the Bank of Canada, all of them at the same time, slashing access to cheap money, and that's not going to happen.